2008 was a turning point in financial history. The entire global system was willing to achieve a guaranteed collapse in the long run, but temporarily it could put it off. There has never been a country or empire which survived money printing. Devaluation of a currency has never worked, and yet every single country globally has decided to do this all at the same time. I have a feeling I know the outcome. You came here for the truth, so let me unveil that for you. Today we're going to look at several charts. I'm going to show you a couple articles connected in with those that are really screaming overvaluation of stocks today. I would like to begin by saying I am not saying that the stock market in the US is going to crash tomorrow. I'm not saying that. What I am doing is presenting to you charts and articles, and you can make the decisions for yourself. Now, we got that over with, that disclaimer. Let's begin by taking a look at this out of Forbes. Despite the volatility and brief correction earlier this year, the US stock market is back to making record highs in the past couple weeks. To many observers, it seems like downright bulletproof as it keeps going higher and higher, going for nearly a decade. All right. Now, unfortunately, this unusual market strength is not evidence of a strong organic economy, but of an extremely unhealthy artificial bubble economy that will end in a crisis that will be even worse than we experienced in 2008. And he goes on to talk about the charts that they'll show. This is actually a writer out of Real Investment Advice. Great site that I've talked about many times before, but the article, he's contributor to Forbes. So we're seeing that here. This is one of the charts that he shows is Fang Stocks versus the S&P 500. Now, you can look at the S&P 500 as a whole. It has done very, very well, but compare that to the Fang Stocks, and suddenly everything looks real different. All right, so we can see that the S&P 500, including these right here, would show us, look, this blue line, that's the S&P 500. Okay, looks like a fraction, but compare that to the Fang Stocks. I mean, look at Netflix. It's just astronomical in terms of the growth that we've seen. This percentage change, by the way. But even if you were to just look at the NASDAQ, break it down even further, looking at the Fang Stocks, compare that to the S&P 500. Okay, then I want to also compare the global stock markets. You start to get a really different picture, okay, when you look at all of the factors. I don't just say, well, look at the S&P 500, it's hitting new highs. It's not fair to say that, because you have to look at all stock markets. The average person simply invests in the Fang Stocks, a few of them, and what they do is they only see those stocks because that's all they have their money in. So they do not address any other stock market, any other factors, any other indicators, simply because they see their stocks going up. Well, they're not really investors then. They're really just speculators, and that's what it is. And that's okay, but that's not really what we do here. Okay, on the Money GPS, we look at all the indicators, and then you make the decisions for yourself. It has nothing to do with what you see on the mainstream media and other things. Okay, that's not what this channel is about. 10-year, 2-year U.S. Treasury spread, we are now in the warning zone, headed towards that recession zone. So you go back in the pages of history and you can see there's this yield curve that they keep talking about. And every time, it's simply a matter of fact that we enter into this zone and we have a very big problem. We're heading in that direction. I mean, it's pretty obvious. But will that be the trigger? No, that's not a trigger, but that is a leading indicator, okay? So we're not quite there, but we're just about. So once this happens, it could happen within, some people say 6 months, some people say 12 months. I don't really know. Okay, this is not the way I look at it, and these numbers can change over the years. Who knows? Who knows? Because we have so much QE money that has been printed into the system, you're not going to be able to address things as you would previously. Buybacks and dividends paid versus the S&P 500's value. So that blue line that you see there, that is the S&P 500 on January 1st, going like this. Basically, every January 1st, trying to just look at those dates through the years. And obviously, since the financial crisis, been rocketing higher and higher. But you look at the dividends and buybacks. I mean, it is quite staggering to see the level of buybacks that these companies have been engaging in. And I've talked about this in my previous video, that these companies, they do buybacks that pushes the price up, and then the insiders sell some of their shares. This happens consistently. I have brought this up on the channel, not just in the previous video, but many times before, documenting when they do this, and people still are so oblivious to what's going on. Dividends may very well shrink simply because of the valuations that we're seeing today. People are attracted not to dividends, they're attracted to appreciation. That's all the average person cares about, and that is a big mistake. S&P 500 versus the NYSE margin debt as a percentage of the GDP. Big mistake. People are doing this. This happens every time. You can see margin debt accelerating here, and that's a percentage of the GDP, but just in general. We're looking at this. By the way, the blue line is the S&P 500. We're looking at this, and it's quite unfortunate that people will use margin, especially to the degree that they do. This number is always going to be a problem. See, during the recessions, during this period of time, people are uncertain, people are scared, so they end up getting rid of this, or they go bankrupt, or they end up with some empty pockets. Either way, they start to deleverage. We had a little bit of deleveraging during this 2008, 2009, and into 2010 time frame. However, today, that's not the case. Everything is just doing fine, so people just push it to the absolute maximum. If they can get more money on margin, they're going to use it. That's a matter of fact. You can ask. I bet you if you asked to 10 actual investors, I'm not talking about individuals who've been, buying into their 7 shares of Amazon. I'm talking about actual investors. Most of them would probably say that it's good to use margin as long as it's responsibly used. Of course. This is a VIX index, and what I found interesting was that if you looked at it previous to the financial crisis, it was the same kind of thing. It had this sort of relaxed environment. And other than a few blips along the way, which is inevitable, we are seeing here the same kind of environment being built up. It's the calm before the storm. I don't know if it's going to hit the level it did back in 2008, 2009 timeframe, but doesn't even have to. This is not really the best indicator because the VIX is manipulated, and it is confirmed that the Fed has a short position on the VIX. They admitted that. It was Powell, actually, who did so. This is the cyclically adjusted PE ratio, the CAPE as it's known. We're looking here at just another indicator, and we are in, again, the everything bubble territory today that we haven't seen since the dot-com boom, far surpassing what we saw during the financial crisis. And hey, nobody really cares anyway. Oh well. Looking at this stock market cap to GDP ratio going far beyond. Again, financial crisis and dot-com boom and bust. Now, I have to start to add these all up. I don't look at any one indicator, as many people like to do. I would call them the negative people. They would say, look, you're just picking one indicator. It's not good because of this or that, and that's why you're wrong. There's not one indicator that I like personally. I like them all. I like all indicators, even no matter how small it is, how little importance the average person may give to it. I like it because it's another piece of the puzzle. I want as many of them as I can possibly get, as many of them. Tobins Q Ratio, which I've brought up before. This one here continues to head higher and higher. We're looking at that right now, going past this, the point of basically considering it to be overvalued. And here we are yet again. Corporate debt outstanding as a percentage of the GDP, far outpacing what we've seen before. This will probably just go higher. Why not? Why not? The GDP is not going to have any real growth, actual real GDP, and instead we're just going to get more debt. That's what's going to escalate, and I can be pretty sure about that. Now, speaking of debt, the debt to GDP ratio is excessive, to say the least. Look at this. This red area is the GDP, which we know already is a manipulated number. They're pushing it up. Where should it be? Hey, I don't know, but it's supposed to be lower. But we have a way to basically get this to look prettier than it is. Well, just like the lipstick on a pig, we can see that the debt to GDP ratio shows the weakness which underlines all of this. Debt securities and loans, seeing how massive, how gigantic. Now, it's been going on for a while. This isn't a new thing. But since the financial crisis, and by the way, you see that? That small, very, very small deleveraging that was occurring almost collapsed the entire system. Always remember that. And so we have this constant and never-ending debt that just adds up and up and up. And they make an interesting point down here. Interest rates have been rising off of their all-time rock-bottom lows over the past 2 years. While still low by historic standards, the rise is certainly material enough already to make the U.S.'s $70 trillion in total debt more expensive to service, putting an ever greater weight on America's already burdened economy. You have to understand that all of this debt has interest rates behind it. Interest rates rise, you can't service it. And even if they remain where they are, as the debt expands, the payments need to expand as well. So whether you keep them where they are, whether they increase, I see them as increasing very, very slowly, way too slowly. But looking at this, we've got a big problem on our hands, no matter how you slice it. In 1971, the U.S. debt to GDP ratio is 1.4 times. That's roughly the same multiple it had averaged over the prior century. But today, the ratio has spiked to 3.47, more than doubling over just 4 decades. Basically, as the debt adds up, it really goes exponential. And we need to be looking at this and understanding what debt can do. You don't need to look at it in the eyes of the mainstream media and all the naysayers that believe we can just print our way out of this mess. There has never been an empire which has survived money printing. It has never occurred in the history of the world. Every single currency, including 2 in the US alone, has been destroyed because of devaluation. They do it intentionally, just like they put copper in the money to devalue it and debase the coinage. Today they do so with the digital printing press. If you found this video informative, please give me a thumbs up. I am really appreciative of that when you do so. You can comment on the video to support the channel. You can hit the subscribe button to support this channel. You don't have to give a dime. That's all. Now, if you want the financial education you're not taught in schools, these 2 books have it all. You're going to learn everything you need to know from A to Z, the foundation, the history, the asset classes, and what exactly to do in the Money GPS. In Global Economic Collapse, you're going to get all of the blanks filled in for you, the things that I didn't cover in the Money GPS. You're going to learn about reducing your expenses, making money, reducing your debt, and familiar topics from the Money GPS, of course. Check them out at the link in the description. And if you're more interested in the audiobook version, you can get that at themoneygps.com.